Over the past 12 months, 9 straight rate hikes, right? Only about half of them are in the economic soup at this point, even because interest rates hikes typically take 6 to 9 months to sort of make their way into the economic system. So be curious to see how the rest of this year plays out as all of those interest rate hikes that happened in the back half of last year start to come on board. However, if you've bought a house lately or shopped for a car or had a credit card bill, you know that those rates actually came into the economic system pretty quick when it comes to what the interest is that you are paying on that. So we thought it would be important to sort of talk about what the implications are and what the impact that these higher rates have so that you can make better decisions along the way. That, after all, is the premise of the program, right? Aptly entitled Dollars and Cents. We help you make sense out of all of life's financial decisions involving your dollars. We're one of Central Florida's longest running radio programs, also one of the top 25 financial planning podcasts on the World Wide Web. So check us out there on your favorite platform of choice. Go to our website if you have any trouble finding us, nelsonfinancialplanning.com. My name is Joel Garris. I'm a certified financial planner and a certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So jumping rates ultimately are going to have an impact on the economy, but more importantly, they are hitting your wallet very quickly these days. Credit cards in particular is where the credit card companies don't really wait a long time before they change those rates to reflect the current interest rate environment. And the jump in interest rates can certainly have some major implications on the costs associated with credit cards because the federal funds rate, that overnight rate that the Federal Reserve sets, ultimately impacts the prime rate, which credit card companies use to ultimately determine the APR, the annual percentage rate on that credit card. And certainly a tremendous amount of credit card debt outstanding, almost $1 trillion at year-end 2022. So that's a lot of money that now is at a much higher interest rate. To put it into perspective, credit card accounts carrying balances averaged an APR of about 20.4% in the fourth quarter of last year, up from just the year prior, an average of 16.4%. Folks, that's a 25% increase in the interest cost on your credit card. So that's one of the biggest reasons why we always talk about on this program, hey, you really need to make sure that you're keeping those credit cards all paid off. Build the emergency savings fund. That's always step one. And then step two is some of this really high interest rate debt really requires you to sort of have that be your next step to sort of tackle on things. If you're looking at a home, certainly those numbers have changed as well. Similar impact there. What was 4% or under 4% on 30-year fixed rate mortgages now gone up to about 7%. Not quite that high right now, but if we simply look at the example of a 30-year mortgage of $100,000, although I probably can't buy a house for $100,000 anywhere in America today, but it's an easy math example. So on $100,000 of mortgage, when interest rates are 4%, you're going to pay about $477 per month of principal and interest. When mortgage rates are 7%, that same number goes to $665 per month on that same $100,000 mortgage. That, folks, is a 40% increase. So a pretty significant increase in that monthly payment on your mortgage. And I guess what's surprising is still not quite into the pricing of housing. And that could be that Florida is relatively unique in that there's a lot of people coming into the state. And so there's still that ongoing demand. And so the impact of those higher interest rates really aren't quite showing just yet. But remember, there's always that lag effect when it comes to interest rates and how those ultimately play out. Similarly, on car loans, right? New cars, the interest rate over the course of the past year has gone from like 6% all the way up to 9%. So when you look at the average payment for a new car, it's now over $700 per month. So maybe look at making that existing car last longer, because that's certainly a pretty significant payment when it comes to monthly payments on a car. So if that doesn't show you sort of where the real impact of those higher interest rates is hitting, you can certainly see that. Credit cards, housing, cars, and certainly underscores the need to make sure that you are really paying attention and not running up credit card debt. The average rate on that now over 20%. That's just a really high number to get out from under. Once you start having credit card debt, it really starts to snowball pretty dramatically in terms of not being able to get on top of that. So really got to watch that. The only silver lining, if you will, on all of these higher interest rates is what you are seeing on your savings account. But beware, because a lot of those savings account rates haven't moved in lockstep to the increase in interest rates. A lot of banks have been very slow to raise their interest rates on savings or savings accounts and the like. So make sure you're really taking a moment to sort of shop around on can I get a better rate with the banking institution that I'm using? If I move money over to a savings account or a money market account, is there a better option where I can make a little bit more interest along the way? I think you may be surprised at how easy it was. We just engaged in this exercise a little bit ago here at Nelson Financial Planning, and then all of a sudden it's like, yeah, we can do that, and you can have a savings account for some of the extra cash that's sitting in these business accounts and lo and behold make 4%. And I'm like, why did we have to ask? But you have to ask, because they're not going to be all that willing to share that with you. So make sure you're asking those questions. If there is a silver lining on all of these higher interest rates and those kinds of things, it really is that you've got the opportunity to make a little bit more on your savings account. So make sure you're getting the best savings rates out there. Ask the questions as it relates to your banking institution so that you can get a little bit more money and at least take advantage of the silver lining that comes with higher interest rates, that ultimately the savings rates winds up being a little bit higher on that end. So just certainly some things to be thinking about of what the impact is on higher interest rates. A lot of negative in terms of higher interest rates, particularly if you're in the home purchasing market or the car buying market, or if you've got any credit card debt. But make sure you're also taking care of that sort of silver lining, if you will, in terms of interest rates on savings accounts. With that, we'll take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning.